taxes and your investments. Maybe you just filed your returns. You owed money, didn't feel very good. It was due to capital gains, dividends, interest income, something on the investment side of your portfolio that just created this unexpected tax bill. Okay, the good news is you're making money on your investments. Bad news is it doesn't feel good to actually pay in. But what we're going to talk about in this video here today, just some simple strategies you might consider to mitigate or control that situation with your taxes a little bit better. 6 or 7 things we're going to walk through pretty quickly. Now, the majority of this stuff applies to taxable investment accounts. We are going to touch on retirement plan contributions as well as credits and deductions too. So I'm gonna try to keep this short and sweet. I know taxes are tedious. Let's get right into it. First on my list, are you looking for tax-free interest? Those options do exist. Municipal bonds will pay you tax-free interest on the federal level, as well as the state level if the bond is issued in the state where you reside. United States Treasury bonds also offer tax-free interest on the state level, unfortunately not on the federal level though, but that can create a little bit of efficiency anyway, right? In contrast to that, corporate bonds, money markets, savings accounts, CDs, all those things pay interest that's fully taxable as ordinary income, all right? So by shifting things around, you may be able to create a little bit of efficiency. Just depends on what the goals are for your money within your investment portfolio. A lot of considerations, but take a look at those options, see if they're a fit for you. Number 2 on my list, qualified dividends and long-term capital gains. These both receive favorable tax rates, generally lower than ordinary income tax rates, right? Long-term capital gain is simply an investment that you hold for more than 12 months. At that point, you receive the favorable tax rate. Short-term capital gains, anything less than 12 months with that holding period, you're gonna pay tax as ordinary income. And you also wanna look for qualified dividends. They receive those favorable rates as well. Makes a difference, all right? So when you're considering investments, look for those 2 things. Holding period matters. Number 3 on my list, trading and turnover. This one's big. It's often overlooked, but if there's a lot of activity, there's a lot of trading in your account, whether it's from you, your advisor, your mutual fund manager, it can be really detrimental from a tax standpoint, right? All that trading and activity creates transactions that then have the potential to create short-term tax consequences, ordinary income tax on these transactions. And even if not, just a lot of trading, a lot of transaction activity creates the potential for realized gains and things that are going to generate that tax liability. Mutual funds are notorious for this, just the way they're set up. You got a mutual fund manager that may be trying to outperform a benchmark, just the nature of them, they're required to distribute any capital gains, any income that comes into the mutual fund portfolio back to you. They're just not very efficient from a tax standpoint for the most part. Next on my list, offsetting gains. What financial advisor communication would be complete without talking about tax loss harvesting, simply offsetting your gains with losses in the portfolio. So if you have an investment that you bought, got a substantial gain, yet you need to sell it for whatever reason, you're simply going to want to look to match it up with something you could sell in the portfolio at a loss, right? This can help be a little more efficient from a tax standpoint and mitigate current year tax liability, okay? So tax loss harvesting, something we always want to look for. Next on my list, do you own tax efficient investments within your portfolio? Some investments are just more efficient than others, right? I mentioned mutual funds earlier. They're often terribly inefficient, right? You got the manager doing a lot of trading activity. They're required to distribute whatever comes into the portfolio back to you. If it's a taxable account, I mean, this can really create a lot of tax liability year after year. That's just the nature of how they're created. In contrast, index funds and ETFs, the way they're created and redeemed, they have some built-in efficiencies, right? You have a little more control over when capital gains, when income is distributed, when you're going to realize these things and pay whatever tax you owe on said gains within the portfolio. Okay, so that might be a way to create a little more efficiency if you own some of these legacy mutual funds that are creating a little bit of a headache for you from a tax standpoint. And as I mentioned earlier, municipal bonds, US Treasury bonds, also more efficient based on the tax-free interest component that they can offer. All right, next up, retirement plan contributions. This one's big, right? So it's not going to apply to your taxable money, but it's a great way to get deductions. It's a great way to be thinking longer term about today versus tomorrow when it comes to your retirement income plan, taxation, etc. So to get to the point, traditional contributions receive a current year deduction. They can reduce your taxable income this year, okay? When you take that money out in the future from your 401k, IRA, whatever it is, money comes out fully taxable as ordinary income. So that's one thing you do need to remember, but it depends on where your tax rates fall, right? If you're paying more today than you might in the future, that can work to your advantage. In contrast, your Roth contributions, you're not gonna get a tax break this year on them, but they grow tax-free potentially if they come out as qualified withdrawals. This can also work in your favor depending on where tax rates go and just the nature of how we want to design a retirement income plan. You want to have diversification, whatever you want to call it, tax diversification, your tax allocation strategy, your tax location strategy. It's simply the breakdown of where you have money between Roth, traditional, and taxable accounts. So retirement plan contributions can be a great way to reduce taxable income this year by making those deductible contributions. And let's talk credits and deductions a little bit, because this is big and this is a really important part of tax planning. Both of these are hard to come by. And I think there's a little bit of misunderstanding when it comes to credits versus deductions. Deductions are simply a discount, right? So they're going to reduce the amount of taxable income you have in any year, right? So if you had a $20,000 deduction, it would reduce your taxable income, the amount of income that you need to pay tax on. In contrast to that is a credit. It's a dollar for dollar reduction in the amount of tax that you owe for the year. So it's going to reduce your tax bill directly dollar for dollar. So that makes sense. Let's talk about some of the most common deductions. We got mortgage interest, state and local taxes, charitable contributions, those retirement plan contributions, FSA or HSA contributions. Some of the most common things you can see to reduce the amount of taxable income that you have. Consider those, all right? Some of the most common ones there include the child tax credit, the child independent care credit, the American Opportunity Credit, the earned income credit. A lot of these, they phase out as you reach higher income limits. So like I mentioned, they're a little bit harder to qualify for, a little harder to come by, but take a look and see what might fit in your situation. While we're on that topic, we talked about charitable contributions. You want to maximize charitable giving if you can, right? There's a few things that you could look at here. If you're making contributions, consider donating appreciated stock. That way you mitigate the capital gain and you get a credit for the contribution that you make to the charity. So you can win there from that standpoint. Another thing you also might want to consider are qualified charitable distributions from an IRA account. It can make your charitable contributions a little more efficient. I don't know if it was short and sweet and to the point. I tried to get there for you. I hope this has been valuable. We'll try to pack a lot of information in there. Taxes can be a headache, but there are some things that we can do if you're proactive. So hope you found this valuable. If you did, please give me a like, a subscribe, share with a friend, and we'll catch you next time.